Hello, hello, hello. Hello, hello, hello. Okay, there we go. All right, so we're on handout 6, example number 5, and we're finishing up from last Thursday. And the first part says compute taxable income for 2024. So for part A, we start with pre-tax financial income. And this is 160,000. And then we're going to look for changes in DTA. And so we have excess of tax depreciation over book. And so that number comes here from here. And so since we're able to take that depreciation for tax purposes, it would reduce. Sorry, I don't know what happened. Word is funky sometimes. It's going to reduce our pre-tax financial income when we're Do not leave the desk here because for some reason it's not working. All right. So let's start with number one. Which of the following is not considered a permanent difference? So we have interest received on municipal bonds. That's a permanent difference. Fines resulting from violating the law, permanent difference. Premiums paid for life insurance on a company's CFO or CEO, excuse me, when the company is the beneficiary. Permanent difference, right? And then stock-based compensation expense is our answer. Two, the tax rate, when a change in the tax rate is enacted in a law, its effect on existing deferred income tax accounts should be handled retroactively in accordance with the guidance related to the changes in accounting principles. So this is not a change in accounting principles, so that is not correct. B, considered, but should only be recorded in the amounts if it reduces a deferred tax liability or increases a deferred tax asset. Have we ever not recorded one when it increased our liability? Right, we would record that and it would increase a deferred tax asset. So we actually record all of the changes, so that is not correct. Reported as an adjustment to income tax expense in the period of change. That's the answer. We talked a little bit about this briefly. Deferred taxes should be presented on the balance sheet as a non-current amount. Even if some of them are going to be due or change in this next year, they still should be as a non-current amount. And then companies are permitted to offset any balances in the income tax payable against. And this is something that they would have had to already paid. And so it's a related income tax refund receivable or prepaid income tax balance. Any questions on those? Hey, you want the definition of a net operating loss? It's a in tax deductible expenses exceed taxable revenue. So it's just like a net loss. The tax says these are your revenues, these are your expenses, and your expenses have exceeded your revenues. So this results in a loss. Company pays no taxes in a year and incurs a net operating loss. The company may be able to use the losses of 1 year to offset future taxable income. Company, they carry loss forward indefinitely until it is profitable. If a company doesn't expect to be profitable, then must place a valuation allowance on the net operating loss related deferred tax asset. So prior to 2017, you could do what was called a loss carry back. So you may have heard that term before. Since 2017, you're only allowed to carry your losses forward. So it does pose a risk for some companies to whether or not they'll be profitable in the future. Now, the pandemic caused some losses. Those companies are expected to bounce back. And so this is where you might see quite a few of these in existence. Prior years, you could go back to a previous return within the last 2 years and say, hey, give me a refund of those taxes. And that would help your company operate because you had an influx of cash in a year you had a loss. But that is not allowed anymore. You're only allowed to carry it forward indefinitely. So let's take a look at example 1. Okay, so the first one, 2023, we have income tax expense and income tax payable. And that income tax payable is based on your, bless you, taxable income times the rate. And so here we have 230,000 times 0.17. And so your debit for income tax expense is 39,100 and your credit is 39,100. Anybody not sure why I was able to use the 230,000 as both taxable income? And it also shows as pre-tax financial income? Right, so you didn't have that, but also up here, it says that reporting purposes and tax purposes. So you might have missed that if you weren't looking at it, but the correct answer is there's no deferred taxes associated here. Okay, for 2024, here we had a loss of 335,000. So we should be able to set up here a deferred tax asset. And this is the 35,000, excuse me. Times 0.17. And so that ends up being 56,950. And then we're going to have income tax expense. Be a loss carry forward. Of 56,950. So keep in mind that it'll kind of reduce your loss, right? if you're looking at that statement or looking at that, it would reduce your loss. So if I went from financial income minus my tax, here I have 335. Here minus a minus 56,950. And so you would add that to it, whatever that comes out to be. So at 391,950. Like, I'm sorry, it would reduce it. Right, because this is negative. And so you have a negative minus a minus, and so that's a plus. And so you have to reverse that. My apologies. So 335 minus 56,950 would be 278,450. Any questions there? For 2025, so we have another loss. So we have deferred tax asset. And this is the 50,000.19. And that equals 9,500. And then income tax expense. Loss carry forward. 9,500. And then you guys do 2026. So this is a little tricky because we do have income tax expense. Because we had 265,000 in income at 0.19. And so that equals 50,350. But we don't have to pay that, right? Because we have a deferred tax asset. So deferred tax asset is 50,350. Any questions there? Okay, now part B. Says prepare the income tax section of the 2025 income statement, beginning with the line operating loss before income taxes. These aren't debits and credits, obviously. We had an operating loss before income taxes of how much in 2025? $50,000. Income tax benefit. Deferred. $9,500. Loss. Be 40,000. So now you guys give this one a shot. This time it says operating income. So copy that out because for 2026, we have a gain, right? So it should be operating income before taxes. Okay, what was our operating income before taxes? Excellent, thank you. 265,000. Now we're gonna have an income tax expense, right? It's gonna be deferred. Here. $50,350. So our net income is 214,650. Any questions there? Not according to the way that they show it. I think it's implied that this is a deferred tax expense, which is why they do it that way. Okay, we good? All right, so let's look at example two. And I want you guys just to do 2023 and 2024 for part A, just do the entries. Those are the easy ones. That says me, right? I got the answers in front of me. Okay, we'll give you another minute. You get a little ahead and you want to try 2025, you can do that one. Otherwise, I will get there. Okay. So in 2023, we had net income, our pre-tax financial income and taxable income were the same for all years involved. So we're gonna have positive income, so we're gonna have positive tax expense. This is just the 70,000 times 3. So that's 21,000 and 21. For 2024, income tax expense and income tax payable. And this time it's 45,000 times 0.3. That ends up being 13,500. 13,000. Now for 2025, we have a loss. And so we're going to end up with a deferred tax asset and income tax expense for a loss carry forward. That amount is going to be the 260,000. This case, our tax rate 0.3. And so we end up with 78,000. Now it says 23 through 2027 to record the income tax expense, income tax payable, refundable, and the tax effects of the loss carry forward. Assuming that based on the weight of available evidence, it is more likely than not 60% of the benefits of the loss carry forward will not be realized. So this also comes in 2025. And so we have income tax expense for this allowance. We have an allowance to reduce deferred tax asset to expected realizable value. And so we have 78,000 times 0.6. And that equals 46,800. Amazingly, 2026, we bounced back, even though we expected not to have some of it. So we'll see where we end up. So for 2026, we're going to calculate our income tax expense. This is the 90,000 income times 0.2 because the rate has changed for 2026 and 2027. And so this is 18,000. Sorry. And then you have deferred tax asset for 18,000. Which one, when you say?
Yeah, the accountants, you would still put the 18K on this. Exactly.
So we're sorry, so you have a T account,
Yes, you have see that.
right?
And what you know, this is the deferred tax to pay for. So you still put the 18K on the side of the income tax expense, so you get show you part of it's been tax.
Debit,
Yeah,
and then a credit, you're saying would be as a closing entry?
since you're using the deferred taxes.
Yeah, you would not put another entry on, this would be the entry. Now, there is another part to this because we have to look and say, okay, we were able to accept some of this, so now let's go ahead and correct our allowance. All right, and so we have to reverse our allowance. And here, we look at how much we had, so we had 18,000 times 0.6, so we had 10,800. Income tax expense. So I think this is the other part that you were talking about. This is the percentage based on what the allowance. And then we have 2027. Okay, so in 2027, we end up having taxable income of 215,000. And so we want to calculate our income taxes payable. Take the 215,000. Subtract out the previous losses. Multiply that by 20%. Because this 20% is the new tax rate. It's 9,000. Put that in the wrong line. It's income tax payable 1,000. And then you have the deferred tax asset. Which is the 260,000 loss minus the 90,000. 0.2. And so this is 34,000. So your income tax is the plug here, 43,000. And then you have to eliminate the allowance. Because we've now used up all of it. So we have allowance to reduce DTA to expected realizable value. And we had a balance of 46,800. We reduced out the 10,800. So this would be 36,000. And then you have income tax expense related to the allowance of 36,000. We'll pick up here on 10.3. So you guys got where I got the 260 and 90,000. So this, I know it was hard to show it on both, but if you look at your example 2, you can find that is the previous loss, right? So our first loss is 250,000. Okay, 90,000. So we're trying to get the net. So the 215 exceeds that. And so you multiply by 2, it's the difference is 45. If we eliminate per tax out. Try to make it so that when you do this, you can kind of hold them open and see the numbers and what you're writing at the same time so that you can kind of get both eyes on where it comes from, but it doesn't always work. Appreciate you guys. I will see you on Thursday. We'll have a group problem to work on then. Have a good day.